Of ELGi Equipments, they came out with numbers earlier on, and numbers look pretty decent. There was a bit of margin erosion, and profits fell, but revenues were able to hold out. The earnings are largely driven by rise in air compressor sales. But let's touch base with Dr. Jairam Varadaraj, who's Managing Director of ELGi Equipments, for more on the business outlook. Dr. Varadaraj, good to have you on the show. Your air compressor segment grew 5%, bolstering growth in revenues, but it's still not as strong as one would have expected. What's the outlook thereof?
Yeah, you're right. I mean, the compressor, the first quarter results are on the back of a good increase in sales in the compressor business, but we've had 2 months that were a dislocation. The first month of April was internal dislocation of ERP migration, which is now stabilized in place. And of course, we had a bit of a dislocation in June as a run-up to GST. If we had, probably if we were able to mitigate both these, our revenue could have been in the neighborhood of about 7 or 8 crores more, but it's a little difficult to guess at this point in time. Automotive business was dampened quite significantly by both the ERP issues as well as the GST issues, but it's come back quite strongly, and we are back to our projected tangent for the rest of the year, so we should be able to catch up and do well this year.
So, would you attribute this contraction to GST? What is the outlook when it comes to your margins then?
Well, the depressed or less than expected sales growth in the first quarter partly is GST, like I said, partly is internal. The margin compression is a one-time event because of a product mix. I'm not too worried about that. We should be able to come back and recover those margins in the rest of the year.
Okay. Now you have ambitious plans for the long term. You want to achieve a $1 billion revenue in the next 5 to 10 years. How will this be achieved at a time when you're recovering from GST and demonetization, etc.?
I think bulk of our growth, I mean, if you look at our aspiration, we are trying to grow the business outside the country. Yes, India is still a significant part of our revenue, close to 50% of our revenue is from India. But our aspiration is built on growing strongly in the markets worldwide. So GST, in our opinion, is a very transitional issue. We're not too concerned about that. It's good for the nation, but we all need to kind of, the systems have to fall into place and and we all have to get comfortable with it. So I'm not too worried about GST as a short changer for our aspiration.
But what about more investment, and how you would be funding that?
Well, we expect significant investment both for our organic growth as well as our inorganic growth, because the kind of aspiration that we have set for ourselves is not going to happen purely through an organic means. But we have some internal boundaries that we will not exceed debt equity ratio of 1:1 at any point in time. So we have a good balance sheet, and we have sufficient stamina to leverage that balance sheet. And with debt costs worldwide being quite attractive, we don't see a problem in terms of borrowing as well as servicing that debt.
Recorded a CAGR of 14.3% in the last 8 years. That's much higher than what the industry has. You're on track to continue to deliver that kind of a run rate, and and you're on track to become the second biggest player within this space?
Well, we are on track, at least from an aspiration and mental map point of view. Now we've got to convert that into actual delivery. We are working on that. We're working on very detailed, granular plans to make that happen. So you will see us moving progressively in that direction.
All right, we wish you the best and hope you achieve those hallmarks and landmarks, rather, that you've set out for the company. Very ambitious, but for now this quarter was a little bit of a damp squib. The stock though is at 232. Let's move